Crocs Incorporated, ticker symbol CROX, is down almost 5% today after releasing their Q2 2024 earnings. What happened, ladies and gentlemen? Is this stock a buy? Because if you look at the valuation, the PE ratio is about 10, and the forward PE is also 10. Seems like a value stock, right? Well, here is the investor slide deck that was just released by the company. We're going to go through this. We're going to check out everything that they tell us. And then we're going to go look at the financial statements to see what's going on with the company. Because a lot of times, these investor presentations are manipulated to make the company look as good as possible because they can show you information that they want to see. Looking at the financial statements actually shows you more information. So, we have the Q2 2024 investor presentation here. And we got, some hot chick here sitting next to the piano that would totally ignore me. So, Q2 revenues of 1.112 million. That's in millions. Plus 5%. So, we got $1 billion plus of revenue. Revenue growth, 5%. Now, if you look at the data from prior quarters, you can see that Crocs had pretty explosive revenue growth for a while. And this was back, in 2020, 2021, probably because of the HeyDude acquisition. And then all of a sudden, now revenue is basically flat again. Okay, this company is not like a super crazy, insane growth stock. There's a reason that its PE ratio was pretty low. We can see that the most recent year-over-year revenue growth is roughly in line with the prior quarter. They're growing slightly faster than inflation. Okay, is it worth it to buy it? We'll see. Crocs brand revenues of $914 million. The vast majority of this company's revenue, as a matter of fact, if we do the math here, 914 divided by 1112, 82% of this company's revenue comes from the Crocs brand. The shoe with the holes in it. That's pretty significant. So you want to really pay attention to Crocs. North America revenues are up 3%. International revenues, which everybody hates, is up 22%. Basically, a huge chunk of the growth is coming from overseas. This is basically peaked out in the United States, at least according to current trends. This grew at about the rate of inflation, actually less than inflation. International revenues up 22%, direct-to-consumer 14% up, and wholesale plus 14% up. Here's where the problem is. HeyDude. So back in 2022, I believe, Crocs borrowed a bunch of money and acquired this other shoe brand called HeyDude. And apparently this is going to drive the next growth phase of the company. Well, wouldn't you know, the revenues of HeyDude are roughly 18% of the company's total revenues? And they're down 17.5% year over year. Down 17.5% year over year. Direct-to-consumer is down 8%. Wholesalers, which they kind of know what they're doing, I would imagine, down 24%. So a lot of, middlemen aren't buying HeyDudes to resell. That doesn't sound too good. Adjusted operating margin, which is irrelevant, of 29.3%. Never trust adjusted. Never trust adjusted. Adjusted can be manipulated for however they freaking want to do it. Okay? Adjust it yourself if you want. So, okay, they did the math for us. So Crocs is 79% of the revenue. I guess my math was slightly off there. I don't know how that happened. Crocs was 79% of the revenue, whereas HeyDude is 21%. This is basically constricting. Crocs is basically going back to what it was originally. I don't even know why they made that acquisition. They might as well just kept the core business instead of loading themselves with debt for a business that's, contracting. Roughly half of their sales are through wholesalers, middlemen, and then the other half is direct consumer. And roughly 43% of their sales sources of growth are international and North America. So overall, Crocs is basically Crocs. HeyDude, I don't know what happened there. Okay, so they talk a little bit more about the highlights. They show some shoes. Here's some interesting tidbits here. Exceptional international growth from our Crocs brand. Okay, 22%, we know that. China grew over 70%. That is a massive market, okay? So, if you're terrified of China and you think China is just going to go to zero and it's going to depopulate down to 2 people and there's going to be an armed conflict between us and the United States and China, you would potentially be cautious about that market's growth. If you're not as concerned about that, that's actually really encouraging. China has 1.4 billion people. That's a lot of freaking people, okay? And 70% growth is nothing to shake a stick at for such a populous country. Okay, we can also see they have, they sell in India, they sell in Europe. They basically are at all the populated places that are either wealthier or becoming wealthier over time. Okay, so international is going to be the huge growth story of this company going forward, which some of you that probably freaks you out. Remember, that also impacts currency. The US dollar is going to massively impact the changes in this company's revenues. If the US dollar is stronger, what that means is sales they generate in local currencies get translated and generate fewer dollars. So currency is going to have a big impact on this company's, profits going into the sales and profits going into the future. So you want to track the currency markets as well, which is so easy to do. You know what I'm saying? All right, so then they have HeyDude, which is an absolute disaster. Okay, let's see what they have to say here. Solidify long-term brand health through establishing the Wendy and Wally as iconic franchises for the... Yeah, so iconic, sales are down 17%. Maintain price integrity on digital, improved channel inventories. Wow, that's going to really change sales. Open approximately 30 outlet locations. Okay, so basically sales are down massively. Let's open more outlet locations. And enter select international markets leveraging Crocs playbook. Interesting. So they have some financial highlights here. Everything that says adjusted, completely ignore it. Okay, I mean, they use it for comparison purposes, but you can just adjust whatever. So we could see that Crocs' adjusted gross margins, this is the profit just from selling the shoe, excluding like corporate overhead. Crocs is basically the actual Crocs shoes themselves are where the majority of the profits come from. And HeyDude is much less profitable. Still pretty profitable from a gross margin standpoint. They make almost a 50% profit from every shoe they sell. But Crocs, they make a 64% profit, which makes sense because look at the freaking shoe. It's just like a piece of plastic or whatever. So I just don't get this HeyDude thing, man. Like, I think they screwed up on that. At least this is my initial impression. Okay. So, they talk about inventory, blah, 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 blah. Financial outlook. Here's some not so good information. Total revenue growth for Q3 2024, negative 1.5% to 0.5%. This is flat revenue. And if you adjust it for inflation, it's negative. FY 2024, between 3 to 5% for total revenue growth. Flat when you adjust it for inflation, or maybe slight revenue growth if they hit the 5% number. Revenue growth of the Crocs brand is still growing healthily. HeyDude, oh bro, let's acquire HeyDude, bro, is going to be down between 10 to 8%. It's just like a horrible acquisition. At least like in first impressions. I don't know what their strategy is. Okay. So overall, it's you got to ask the CEO what the heck he was doing buying that company. But maybe I'm missing something here. So if we don't look at the income statement, we could see the profit and loss for the 3 months ended June 30th, 2024. So we see the revenue growth. We know they had revenue growth. We know their overall gross profit is they're very profitable, with Crocs, the actual Crocs brand, being the most profitable. Selling general administrative expenses. They actually had some increases in selling general administrative expenses, and it actually grew faster than the change in revenues. So as of the 3 months ended June 30th, 2024, for this quarter, selling general administrative expenses were roughly 32% of revenue. 32% of their revenue was eaten up this quarter based on selling general and admin expenses, versus 30% for the prior quarter. So they had some growth faster than their revenue growth for selling general and admin. I don't know what they're doing there. Maybe it's stock-based compensation, but you want to pay attention to that and ask why that's happening. All right, foreign currency gains and losses. This is what I was talking about. If you're selling internationally, you have to convert. You're selling in a local currency. You have to convert that currency to dollars. And depending on what the exchange rate is, it's going to affect your profit and loss. Interest income is up. That's common sense because interest rates are up. Interest expense is down pretty significantly. That's probably because they're paying off pretty good chunks of debt. And think about this. They paid probably billions of dollars to acquire HeyDude. And this interest expense is directly attributable to that. And it's a brand that's losing sales. The sales are declining. And they're declining even more massively when you adjust for inflation. This is the cost of the HeyDude acquisition, but the interest expense is going down, so that's good, okay? And we got earnings per share of 3.79 with diluted earnings per share of 3.77. So an increase over the prior year, And I think a big reason for that was because of the interest expense, okay? Let's see, shares. So they bought back some shares, it looks like. Great, amazing, awesome. Let's go look at their balance sheet. So they have $167 million of cash and $420 million of accounts receivable. This is their liquid assets. This is money that they can quickly, or assets on their balance sheet that are either cash already or can quickly become cash. They have roughly $587 million of liquid capital there. And they have roughly $686 million of total current liabilities due within a year. So overall, I mean, their cash position isn't the most amazing, but they have pretty solid operating cash flow, I think. We'll see. And I don't think they're going to have some kind of liquidity event. And if you look at their total current assets, this includes inventories, which when you sell inventory, you make a profit. So this 367, when they sell it, becomes $700,000 of cash coming in. Once they sell that, that's more cash flow to pay their short-term bills, other receivables, and then prepaid expenses, which are not liquid. Overall, they have about $1 billion of liquid capital that will be quickly converted to cash or is projected to be converted to cash within the next year. They have enough short-term reserves to pay off their short-term debts. I don't see any massive issues there. Let's look at their long-term assets. So they got property, plant, and equipment. We can see that there's a change. There's an increase because they're, I guess, buying more stores for HeyDude. Intangible assets, this is, trademarks, patents, etc., etc. Went down a little bit. That's because of amortization. Goodwill. This is what they use to acquire. This is what was generated when they acquired HeyDude and potentially other acquisitions they did in the past. Goodwill is just paying more than the fair value of the net assets of a business. Because think about when you buy a business. Let's say the business's net worth is $1 million, and you pay $2 million for it, which you might do because the business isn't just its assets minus its liabilities. It's also all its future cash flows. Well, to balance the journal entry in accounting, you paid $2 million for a business that's worth $1 million. Well, obviously the plug is $1 million. That's goodwill. That's basically what it is. So you can see the goodwill, it went down a little bit. I don't know if it's like because of currency translations or adjustments or whatever. But I would pay attention to this because if this is mostly generated from HeyDude and HeyDude continues to underperform expectations, you could see goodwill impairments, which means they write down this asset on the balance sheet and it hits the income statement. It hurts profit and loss. Basically, they overpaid for a business that they shouldn't have. We have deferred tax assets, $640 million. This is tax savings they believe they're going to get in the future. That this could change, subject to changes in tax law. Right of use assets. Okay, this is leases. So, we see that they've signed, a few more leases, and they've brought more property, plant, and equipment up here. And they have a roughly, it looks like, at least according to the numbers, a 50-50 split in property, plant, equipment, and leased buildings. All right, long-term debt. Let's see. So, this is not good. Okay. So they have long-term income taxes payable. That's an interesting thing that I've never seen before, of almost $500 million. And then they have $1.5 billion of long-term debt. $1.5 billion of long-term debt and $244 million of property, plant, and equipment. So most of this long-term debt basically went to buy HeyDude, all of its assets and liabilities, which are factored in here as well. And the plug was most likely goodwill. Okay? So if goodwill gets impaired because HeyDude sucks, well, the company still has real debt they have to pay. That's a pretty significant chunk of debt right there. I don't think it's going to, we'll see the company's cash flows. But it just seems like that whole acquisition was a disaster. Okay? So long-term debt, but they're paying it down. That's good. I don't know what this long-term taxes payable is. That's an interesting thing they have there. Lease liabilities. This is just future payments to of building leases they have to pay. That has to go on the balance sheet. Let's see. Common stock. So, okay. So they did a little bit of buybacks. They bought back roughly 9 million shares or 900,000 shares. It looks like. They didn't buy back a lot of shares, but they bought back some shares. So we see their share buybacks. And the reason we really know that is because this treasury account number gets more negative. That means share buybacks. They're buying back shares. Additional paid-in capital. When that increases, that means they're issuing shares. So they're issuing shares, but they're also buying them back. So you have to look at the net effect of that. And retained earnings is up, which means they recorded a profit. Accumulated other comprehensive loss. This is most likely because of currency. This is something that skips the profit and loss and hits the balance sheet directly, but you need to pay attention to that because some companies like First Republic Bank, you could have seen a lot of crazy things going on looking at accumulated other comprehensive loss. But just know that that skips the income statement. All right, statement of cash flows. So we start with net income. We add back non-cash expenses. We subtract non-cash gains, and we do subtractions or additions for changes in balance sheet items. So depreciation and amortization is up. So that's because of increased property, plant, and equipment. It's a non-cash expense. Operating lease costs. This is expensing leases before they're paid. Or amortizing leases. Add that back. Share-based compensation is up. Asset impairment. What did they impair? That's interesting. Let's see what they impaired. Hold on. Asset impairment. Do they tell us? They don't tell us. Why don't they tell us what the impairment was? Impairment related to information technology systems and impairment related to distribution centers. Okay. So I guess they had to do a write-down. Oh, here we go. Represents an impairment of information tech systems related to HeyDude integration. Primarily represents an impairment of right-of-use assets for our former HeyDude brand warehouses in Vegas, associated with our move to our new distribution center, an impairment of right-of-use assets. Okay, so it looks like they shut down some warehouses and they moved some warehouses around, okay, because HeyDude is a piece of trash. It's so bad, man. I don't get it. Oh, it's a shoe, bro. It's a really good shoe, bro. So that's what happens when you make bad acquisitions. You start to see the effects on the income statement and the statement of cash flows. All right, so accounts receivable. So we know that basically when they're subtracting accounts receivable, that means the accounts receivable went up. So you record revenue, but you're not receiving the cash yet. That's why it's just a subtraction. Inventories. Okay, we can see the cash flows from inventories. There's a little bit of a variance there, but that's because that's basically if inventory goes down, then you add back inventory because you're receiving cash to the inventory. Prepaid expenses are down. That's because the prepaid account went down. Let's see. Accounts payable. So they subtracted accounts payable versus they increased it the prior quarter. So you see there's differences in, changes in balance sheet items. If accounts payable goes down, that means they paid debt. They paid off some of their short-term debt, which means that's a cash outflow, et cetera, et cetera, et cetera. So overall, they generated, decently healthy cash flow in the first 6 months of $373,000. And most of that cash flow is not going to expanding new stores. It's going to paying off debt. They got pretty solid cash flow, roughly, if you annualize this out, 850 million. Am I doing my math right or 750 million? It's early. They got roughly 750 million of cash flow from operations, and they spend, if you annualize it out, maybe 64 million. So they have roughly 682 million of cash every year to do whatever they want, pay dividends, buy back shares. And they've done, what you'd expect. They paid off some debt. They bought back some common stock. Overall, the brand isn't dying, but my concern would be in the future, Crocs isn't projected to be growing that fast. HeyDude just seems to be an absolute disaster. I don't know, man. They're laden with a lot of debt. I would hope this business pays off their debt relatively quickly. Get out of debt, get over this stupid HeyDude acquisition, and then, return as much cash to the shareholder as you possibly can. So that's my thoughts. If you like the video, hit the like button, subscribe. If you want a personalized video, send me $50 to the pinned comment. If you want to buy my book, Stop Being a Broke Loser, it's on Amazon. And if you want a one-on-one tutoring session, you can send me $75. See the pinned comment below. Talk to you later. Cheers!